Hey, so Chung here from Commercial Finance Experts Academy. Here today, actually just checking a couple projects here, commercial projects, and especially about construction right behind me here. Just thought I answer a question that was on one of the forum. One of the gentlemen, I guess he just recently joined us, and he asked about commercial lender suggestion. Now, it's regarding an operating company and a successful operating business that's been running for the last 19 years or so. They're looking to build an addition to the property, perhaps expand the business, add some kind of component to make the business better. In this case, it was an addition for a brewery. Now, on the surface, the question is great. It's good that somebody's asking for help and suggestions. But this is unlike residential financing, that when you get a lending request, the property itself is one thing, but positioning is something else new that a lot of residential mortgage brokers don't realize. Is like give or take, this building behind me is very straightforward. It's a construction. It's most likely a spec sale, meaning that it's being built to sell. So there's not really anything you can do about it, and it's pretty straightforward. Find a lender in construction financing, finance it, right? Whereas in commercial, like the building behind me there, it's financed differently. If there was an existing business in it, in which case, if there is, the financing on that is different. Take, for example, the question they've asked is that they have a current operating business in it, and how can I finance it? Well, the thing is this. You need to know more. Okay, first of all, if there's a successful operating business on it, and the rent, not the rent, but the additional income you generate from the new property can be also added into the picture. But specifically, the current existing business is an operating business that's probably generating sufficient income to service the additional debt, then you don't really need a construction financing per se, right? They can pretty much do it if it's small enough. It's a small addition. They only require a couple $100,000, maybe $500,000 or so to build an additional. But I guess in this one I think he's requesting about over $1 million, 1.2 or something like that, 1.2, 1.3. So it's still considered pretty small for a lot of the big FI, the RBC, BMO, TD, and all that. They don't like small construction. This is considered a very small construction project for them, right? They're interested in the multi-million, double-digit construction sites, projects that are running into double digits instead of just single $1 million digit. That being said, how can you skin the cat, right? Well, not literally, right? In this case, I think if the financial is very strong, they can pretty much get some kind of business line of credit and have a lien against the property. The current property, if it's worth that much money, they can be able to do it on their own draw and have their own time to do it rather than put in construction. There is only very few lenders that have an appetite for construction projects like this type. It's a very small project, really. It's almost like a single house in the Vancouver and Greater Toronto area. With this in mind, if they can go about to try and get the financing, it's not always the cheapest financing, but it's probably the best path. At least the resistance is probably the best, because if they go towards straight construction, a lot of pushback for one. The majority of the lenders don't want to do it, right? And if you want to get construction financing, the big FIs won't do it. And if they have a relationship with one of the big FI, they kind of cut themselves out of the picture in that sense, right? But in this scenario, I strongly suggest looking at the financial statements and see what kind of income they have, what kind of EBITDA earnings do they have. Sometimes lenders will lend towards the EBITDA of the business, the earnings before income taxes, depreciation, amortization, all that. So if the EBITDA is, say, about $400,000, say $400,000, they can probably get about 5 to 7 times EBITDA in business financing. So they don't really need construction financing, right? Or even a term loan for that matter, because they only use a couple $100,000 at every stage up to the draw is used up into the final draw, right? That's when you want to get a term loan. So different way to skin a cat. If you can get a very flexible operating line of credit, you can do it at your own pace and draw whenever it's required. If they're looking for a term loan right off the bat and basically it's gonna, you have to pay on the $1.2 million that you don't even use at the beginning, right? So that's the cost of credit, right? If you really think about it. For construction draw, it's probably ideal, but then you limit yourself to the amount of lenders you can use. So for example, if their banking is already currently with, the business bankers are currently one of the big FI, it's easy to go back to them and perhaps arrange some kind of operating line or business term loan for them to leverage and draw whenever they need it. That means it costs less, and at the end they can do whatever they want with it, right? Convert it to a term loan or amortize their mortgage once the building is complete. Whereas at the beginning, then you have to draw the whole entire thing, and starts from day one, you're paying interest on money you don't even use. I don't know. Is that some value to your client or not? It depends, right? Find out what your client's beef is and why they need you to help them with the financing in the first place. If they don't care about it, they just want to get the money no matter how you skin a cat, they just want the money, then that's great. You can find them cheap money or very expensive money. Anywhere, the pricing for business financing versus construction, it varies. It really does. Construction finance is more expensive, I find it. So term loans a little bit cheaper, and term loan there's more lenders available out there. Lots more doors you can knock on. Whereas if it's just straight construction financing, you're very limited to perhaps a local credit union or perhaps maybe, like I suggested in my post, Canadian Western Bank. All right, so hopefully this video helps you and to understand it. It is all about positioning, and it's more important that you have to get right position correctly in a commercial file rather than just trying to hammer heads on and try to get the fund approved however which way you can, right? It's a big difference between residential and commercial because of that. Hopefully you can take away from this video, and if you'd like to learn more about it, subscribe to my YouTube video channel on Commercial Financing 101. My name is Su Chung. Hope to see you at the top. Take care. Have yourself an awesome one.